Hey there, I'm Apple Crider from Investing Simple. In today's video, we're breaking down how you can invest if you are still a teenager. So if you're under 18 years old, there are some different rules and regulations you gotta follow when it comes to investing. So in this video, I'm gonna break down for you what specific types of accounts you are able to invest in, where you can open those accounts, and then what things you can actually invest in within those different types of accounts. So let's dive right on into it. Now, the first question on your mind is probably, can I even invest if I'm under 18 years old? A lot of people think that, oh, until you turn 18, you're not actually able to invest yourself, and that's not the case. There are a couple different avenues you can take when investing under the age of 18, and honestly, it's never been easier than it is today with all the different services and apps out there. It is actually pretty easy to get started if you're under 18 years old. But now the question of where. So when it comes to what types of accounts you can invest in as a minor, you've got three main options available to you. The first of which is a custodial account, which we'll dive into in just a second. Next, you've got retirement accounts, and then after that, you've got 529 plans. So we'll dive deep into each of those individually, what they mean, how to set them up, and show you all the ins and outs that you need to know. So let's start off with custodial accounts, and these are also known as UGMA or UTMA accounts. For the most part, these two types of accounts are very similar. You've got your Uniform Gift to Minors Act, that's your UGMA, and then you've got your Uniform Transfer to Minors Act, that's your UTMA. And for our purposes, these two types of accounts are very similar. The main difference between the two is that with a UTMA account, you can hold real estate in that account. You can't do that with a UGMA account, but that's probably not gonna matter much to you, and so for the most part, these two types of accounts are pretty equivalent. Now, how these custodial accounts work is that a parent or guardian has to open this account for you, and they are going to be able to control this account until you reach the age of majority. So depending on your state, that could be either 18 or 21, but until that point in time, your parent or guardian is gonna have complete control over that account. However, once you hit that age of majority, then you now have complete control over that account, and the parent is legally required to transfer all of those assets to you, and you're free and clear to do whatever you want with them. There are no restrictions. You now own that money. So it's really important with these types of accounts that if you're going to open one of these up for your child, you have some conversations with them about the expectations with this account, because when it transfers to them, they're free and clear to do whatever they want with it. So it's probably going to be a good idea to set some expectations and some ground rules before that actually happens. Now, the tax situation with these types of accounts can get a little bit complicated, so it's probably going to be a good idea to talk with your tax advisor if you want to open one of these things up. But in general, the child is going to be the one that is paying the taxes, generally at their own tax rate, unless kiddie tax rules kick in, which those get pretty advanced pretty quick. So for the most part, just know that in general, the child is going to be paying the taxes at their own income tax rate, but that could change, so make sure to talk with your tax professional before you make any financial decisions. But essentially, these accounts function very similar to traditional taxable accounts where you are able to buy and sell different securities and whatnot. And one of the best places to open up one of these custodial accounts is with First Trade. So they offer these completely for free for you to sign up for. You can create a custodial account for your child, get some money in there, invest in some stocks, bonds, ETFs, etc., and get that growing for them so that by the time they reach the age of majority, they've got a decent chunk of change set aside for them. And if you are the child, then it's probably going to be a good idea to talk to your parent about getting one of these things set up for you, because you are not able to do it without their signing off. And we've got a link to First Trade custodial accounts down in the description below, so you can feel free to check those out if that is something you're interested in. Now we're going to dive into retirement accounts, because as a minor, you're also able to open up different retirement accounts. These are going to provide you with potentially some tax benefits over time if you do choose to invest that money until you decide to retire. So you've got two main options of retirement accounts. That's your traditional IRA and your Roth IRA. These both have variations specifically for minors, so that's going to be your minor traditional IRA, your minor Roth IRA, and these are going to be available to you if you're under the age of 18. Now, this is not tax advice, but minors are generally better served by a Roth IRA than a traditional IRA, because the difference between the two is with a Roth IRA, you pay taxes today, and then in retirement, you don't pay taxes if you follow the rules of Roth IRAs. But with traditional, it's the opposite. So you don't pay any taxes today, and then in the future, you do pay taxes when you retire. So if you're a child, if you're under 18 years old, you're probably not making that much money. You're probably not in a very high income tax bracket. So it might be advantageous to you to pay the taxes today and then not pay taxes when you retire. But if that's not the case, maybe you're some kind of child actor, you're making a lot of money, then it might make sense to consider a traditional IRA. Again, that's going to totally depend on your personal situation. Another requirement with these retirement accounts is that you need to actually have earned income in order to contribute to these things. So if you don't have any income currently, if you don't have a job, then you're not going to be able to contribute to a retirement account. However, people can get pretty creative with this stuff. I know of people who have their kids hired as like child actors if they have a YouTube channel, or different things like that. So there are ways to get creative with this, work with your parents to find some kind of creative way to earn income on the side to put into your retirement account. So even if you don't technically have a job, there are still ways to contribute. But essentially this account is going to work very similar to the custodial accounts that we talked about, where you can invest in different kinds of stocks, ETFs, mutual funds, etc. And when you're opening up one of these retirement accounts, you are going to have to go with one of the legacy brokers. So none of these apps, even the ones that do offer retirement accounts, offer retirement accounts for minors. So in order to open up one of those, you're probably gonna have to go to somebody like a Fidelity, a Vanguard, a Schwab. These guys offer these retirement accounts for minors. The newer apps like Webull and M1 Finance only offer retirement accounts for people that have already reached the age of majority and are old enough to invest on their own. Now, the last option for investing as a minor is a 529 plan. And these also offer some tax benefits similar to your retirement accounts. And a 529 plan specifically is tailored towards education funding. So parents or grandparents typically set these up for their kids to fund their college education, but they can also be used for K through 12 education as well if you do go to a private school. Now, similar to any other tax advantage account out there, there are going to be some limitations here. So the limitation for a 529 plan is that you can only put $15,000 into it every single year. That's $15,000 per contributor. So your mom could put in 15 grand, your dad could put in 15 grand, your grandpa could put in 15 grand. And so as many people as they want can put in 15 grand every single year, but no more than that. Once the money's in the account, the person who opened the account, so typically your parent or grandparent, will be able to invest that money into different, again, stocks, ETFs, mutual funds, etc., and allow it to grow over time so that when you reach the age of needing to go to college, you have that money there for you. And then if you do withdraw the money for college, it's going to be completely tax-free, those gains. So say your parent put in 15 grand, by the time you go to college, it's worth 50 grand. That $35,000 of gains will be tax-free, provided you follow all of the rules. Now, one thing to keep in mind with 529 plans is that they're not technically owned by the child. So your parent or grandparent or whoever opens this thing is going to be the owner of this account. And so they can transfer this account to a different beneficiary. Say you decide not to go to college, but your sister goes to college, they can transfer it to your sister very easily, or they can withdraw the money themselves and face the penalties and taxes that are going to be associated with that. So the parent or grandparent has total control over the account, but again, it can be used for the benefit of the child for going to college and get some serious tax benefits in the process. Now, when it comes to opening up a 529 plan, our pick for the best provider is going to be Betterment. In addition to all the other investing and banking stuff they got going on, their 529 plan is one of the best out there, especially for young people today. All right, so now you know your options in terms of different accounts, but what can you actually invest in within these different accounts? Well, you've got four main options for the different assets you want to invest in as someone who is under 18 years old. These are your four main options. The first of which is to just put it in a high yield savings account. Okay, so Betterment, like we mentioned, they have a high yield savings account where you can earn an above average rate of return on your dollars. So just parking them there, they're FDIC insured, and you don't have to take on any additional risk. But with little risk comes little return, and when compared to some of the other assets out there, you're potentially going to be getting a much higher return elsewhere. So your next option is investing in stocks and ETFs. So ETFs is exchange traded funds. These are basically baskets containing lots of different stocks, or you can invest in individual stocks. Now that's going to be best done through a first trade custodial account like we mentioned before, but within one of these accounts, you and your parent and guardian are going to be able to work together to purchase individual stocks, ETFs, etc. Again, because you don't own the account yet, you are not able to place trades. So if you're under 18 years old, you can't place trades, but you can have a conversation with your parents, you can help and kind of make decisions together, but they do have the final say in those investing decisions. Option number 3 is to invest in bonds. So essentially companies can raise money in one of two ways. They can issue stock, they can issue bonds. Bonds are essentially debt. So if the company wants to take on debt, you can buy a piece of that debt. They're going to pay you periodic interest payments. And in general, these returns tend to be lower than returns you're going to get from stocks, but that's because they're a little bit safer, a little bit less risky on average. So you can also purchase bonds through a first trade custodial account. Again, you can't make the trades yourself, but you can work with your parents to make those decisions there. You can also purchase bonds directly through the government, and the government offers these things called Series EE bonds, which also provide tax benefits to you if you are going to be using them for your college funding. So similar to a 529 plan, you can get some sweet tax benefits from these EE savings bonds, but there are a ton of rules and regulations around those, so you'll want to do a little bit more research before you decide to invest in those. And then your last option, option number 4 for how to invest as a teenager, is to do what's called robo-advising. So in the past, you really had to choose between, do I want to buy individual stocks myself, kind of pick and choose, or do I want to work with a financial advisor, have them do everything for me? Now there's kind of this middle ground where you can work with a robo-advisor that kind of combines these two. It's got lower fees than your traditional financial advisor, but more kind of guardrails and suggestions and just help for you than just doing it on your own. So Betterment, like we mentioned with that 529 plan, they've got the 529 plan and they've got robo-advising. So within your 529 plan with Betterment, you can basically work with the robo-advisor to pay a small fee and basically have your portfolio managed for you, get it tax optimized, all of that good stuff. So it's a very hands-off process. You just put money in there, you sit back, you wait until you are ready to go to college, and then hopefully you've got some serious gains there that you can use to fund your education. Again, with that 529 plan, it's going to be completely tax-free when you go to take that out of there. So those are your 3 types of accounts and your 4 different investment choices that you have as a minor or teenager that wants to get started with investing. Now, one thing that I think is really important to keep in mind, that when you are investing, especially as a young person, that you take a longer time horizon to it, okay? You're not probably gonna be day trading if you're 16 years old. You're probably gonna be more focused on investing for the long term, growing your wealth over time, because as an investor in the stock market, you've got 2 main ingredients for growing your wealth. You've got time, you've got money. As a young person, you probably got a lot of one of those, not so much of the other one. So you can really use the time to your advantage and start making some serious gains by just investing a little bit every single month or every couple of months whenever you've got money that you can set aside. Now for a quick example here, if you're 18 years old, you could invest $175 a month, which might sound like a lot, but it breaks down to about $6 a day, a little less than $6 a day, and retire a millionaire. So for less than $6 a day, as an 18-year-old, you've got so much time on your side that you don't actually need to invest that much money to retire a millionaire. Again, that's investing in the stock market, assuming an 8% return. So keep that in mind as you go out there and get started investing. Also keep in mind that all investments do involve risk. Nothing out there is guaranteed. So if you do decide to put your money into stocks, into bonds, into robo-advisors or whatever, there is going to be risk associated with that. And you could potentially make some mistakes, but it is best to make those mistakes, I think, with a smaller account balance than a larger one. So if you can learn those lessons early on when the numbers are smaller, then when the numbers get bigger, you don't have to make those bigger mistakes. So the next time someone tells you you're too young to be thinking about investing, you know that's not necessarily true, and there's never been a better time to invest as a young person. Now, if you want to learn more about how to invest as a teenager, we have a full comprehensive guide going on over at our blog, investingsimple.com. The best way to find that is to go to Google, type in how to invest under 18, and click on the link for Investing Simple. We will see you over there.